Good afternoon, everybody, and welcome to today's Professional Advisor Working Lunch, brought to you courtesy of Baillie Gifford. I'm Jen Frost, editor of Professional Advisor, and I'll be your host for the next hour. Now, before we get cracking with today's session, I do need to run through just a little bit of housekeeping with you. I should inform you this session is being recorded. We will send you a link of the recording tomorrow. You can absolutely feel free to share this with your colleagues. As usual, today's working lunch will qualify for 1 hour of CPD. We will send you proof of attendance along with a link to the recording of the session, and this will arrive in your inboxes tomorrow. I'm joined today by Ian McCombie, Head of UK Equities at Baillie Gifford. Now, Ian is going to explain Baillie Gifford's view that the best kept secret in investing may be sitting right on your doorstep. Ian will explain how and why the UK is overlooked for growth and innovation, but is home to world leading companies priced at a discount to their international peers. Now, as we go along, please do feel free to put any and all of your questions to Ian using the chat function. You should be able to find this at the bottom of your screen. If you do wish to remain anonymous, you should be able to send a message directly to me. Simply select my name from the drop down list in the chat box before you type your message so that only I can see it. Now, just before I do hand you over to Ian, let me quickly run you through your learning objectives for today. By the end of this presentation, Baillie Gifford will have dispelled the myth that the UK market is incompatible with growth, looking beyond the largest index constituents to demonstrate growth investing in the UK works. Discussed where the hidden gems are lurking, giving insights into some highly innovative companies run by exceptional management teams, and demonstrated why their distinct approach to UK investing can unlock the vast potential on offer. So that's the CPD covered. Let's hear from Baillie Gifford's Ian McCombie. Good afternoon, Ian.
Afternoon, Jen.
Ian, just to kick us off, could you please give us a brief overview of what the UK Growth Trust offers for shareholders?
Sure, thanks, Jen. Good afternoon, everyone. So, as Jen said, I'm the head of UK Equities. I'm also co-manager, along with my colleague Milena Maleva, of the Baillie Gifford UK Growth Trust. Now, to answer your question, Jen, I'm just going to go through a couple of slides and really kind of highlight what I think are the key aspects of the trust itself. So, just trying to do this myself. It's coming through, hopefully. Doesn't seem to be working at the moment. Here we go. One more slide. Yeah. Apologies, just getting our gremlins of the technology working. Yeah, here we are. So our offering is really three things. It's about active management. So we have about 36 stocks in the portfolio at the moment. It's really much our best ideas, in the portfolio. And it's really about backing our judgment. And I'll have a slide later on, Jen, to kind of really kind of highlight for the viewers just to what I mean by that. So very much active management, which is important to kind of to beat the market. You've got to be different from the market. I think the second thing that is really important is patience. We are genuinely long term. I know a lot of people talk about it, but if you look at our portfolio turnover, for example, it's very low, and it's a good example of the fact that we like to run the holdings that we do. And the reason for that is really kind of couple of fold. First is the power of compounding. Let it work for you. So when you've got these, what we think are great growth businesses, you want to own them. And that last point on the slide really is about growth. And that's really the key thing, because our insight really is that in the long run, share prices follow fundamentals. Now, we'll talk about performance, I'm sure, soon. And in the short term, that doesn't always work. But if you look at it on the long run, we are very confident that if you have a portfolio with above average growth characteristics, you will be rewarded for doing that. And that's what we firmly believe. And the team have been running portfolio money on the institutional side for well over 30 years, and that's very much what we've been doing. We've had periods of performance when it hasn't worked, but actually that's the reason why you want to stick to it, because in the long run it does work. So that's really kind of an overview, Jen, of the trust.
Thank you, Ian. And you mentioned performance there yourself, of course. Um, I believe the trust has recently reported its annual results to the end of April. Can you sort of shed a bit of light on how it has performed in the past year?
Yeah. So I mean, for the year itself, the NAV, the net asset value, was up about 7.1, and the index was up 7.5%. So slightly underperformed, which is a bit disappointing. In share price terms, actually, shares are up about 13.8% as the discount of the trust actually narrowed down. So a little bit behind, but actually it's almost like called Jen a kind of tale of two halves, because the first half of the year actually performed quite strongly. But then in the second half of the year, as everyone will probably remember, that the Trump tariffs, which kind of were announced kind of at the end of in April, and that caused a bit of a market meltdown, and growth investors, had a bit of a tough point at that point. So that's really kind of dragged back performance, for the year. What's interesting, I guess, is since the year end of April, we've actually had good performance. We've outperformed by about 4.5% to the index. So it actually kind of fits the point that actually, as the market has kind of slightly kind of calmed down after the initial kind of tariff thing, starting to look back at fundamentals, which is good in the short run anyway.
Thank you, Ian. And I think I believe that performance in the sort of preceding few years was perhaps less positive. I know it was a difficult backdrop for growth investors, wasn't it? But I mean, looking ahead, you seem to be quite excited about the potential for UK growth stocks.
Yeah. Well, look, I mean, the first thing I think for any kind of shareholders or people who've got clients who have been shareholders in the trust, look, we acknowledge that the last few years have, really tried, your patience, and it's at a tough point. But as you said, Jen, I think there are kind of a number of factors there that I think are worth just unpicking a bit, because I think they're really important as to why we are more positive looking forward. And I think the key point, as you kind of put the nail on the head already, is just saying, well, actually, it was a really tough environment for growth investors, not just in the UK, as I'm sure our clients will know, other Baillie Gifford funds. It's been a pretty tough time for growth investing wherever you are. And that's really in the UK, for example, just interest rates going from virtually nothing to, the levels that they are now. Inflation obviously going from pretty low levels to kind of pretty high levels, come back down again, but it's still remaining, stubbornly high. And that in the short term has not been good news for growth investing, and that was a bit of a headwind for us. But what I think is interesting, Jen, is one thing is that we were challenged by our board of the trust, and I think that's a really important point. You've got an independent board that are, representing shareholders, and they kind of really challenged us and, said, well, look, I appreciate this, but what could you have done? Or what could you have done differently, to perhaps mitigate that? And I think what was really interesting, Jen, was that we looked at the data, and if you had perfect hindsight and able to say, well, actually, there's going to be this big shift from, growth into, what could you have done? And we realized, actually, you look at performance data, it wasn't like one or two stocks that went wrong. We did have mistakes. Obviously, we could talk about that if people want to, but actually, it was across our virtually the whole portfolio. So it was a style thing rather than one or two stocks that had kind of blown up on us. And really, the only way we could have ever outperformed is we'd actually sold all our growth investments and bought kind of value investments, which I think, shareholders have been saying, well, what the heck are you doing? You're a growth manager. So I think we kind of looked at the data, and the data said really there was no real way of avoiding what happened to us as growth investors. So that's the kind of the kind of the tough thing. But actually, there's a more positive story. And if I go to the slide that's coming up here, I think it can really demonstrate, why we're feeling more positive about things, Jen. And let's get it up here. Hopefully, coming up. Yeah, here we go. And what the slide on the left hand side is trying to break the UK market down into kind of growth quintiles. And this is looking at data of 5-year earnings growth, looking back at data over the last 35 years, and it's trying to group investments into the lowest growth on the left hand side there to the fastest growth on the right hand side of that bar chart. And what you can see there is that the faster earnings growth companies actually perform better than the slower growing companies. So that kind of gives you that point that I said earlier, that share prices kind of follow fundamentals. Well, there's the data that actually backs that up in the UK. So, and that's the same globally as well. There's nothing different here. And it was interesting when we did the data, people thought, well, the UK might be different. No, it's not. Fast growth does get rewarded. But there's a wrinkle in that, Jen. It's easy to say that, but if people are looking at the chart closely, they'll say it's the rolling 5-year numbers. So actually, it's 5-year earnings growth. And if you think about the last 5 years, we've had COVID, we've had recession, we've had, as you said, interest rates and inflation. There's been a lot of distortions in the last 5 years. So actually, for people to try and understand, is a company a growth business or not, it's actually been quite tricky because there's been a lot of distorting factors there. But we think fundamentally, has anything changed? No, we don't. And then the second point, which I think is really exciting for potential investors, is on the right-hand side of that chart, that the UK is on sale. What do I mean by that? Well, look at the discount of the UK relative to the global market. And yes, you can see on the right-hand side, there's been a little bit of a tick up recently, which is nobody's really talking about, and all the doom and gloom about the government and the economy. Actually, the UK economy is doing quite well. Sorry, the UK stock market. But look at it on a 5-year or 10-year basis. We are still starting from a very low point. There's still a lot to go for. And I can see that on the individual basis. Melania and I, when we're looking at stocks, they are typically looking at a discount to their international peers. So yes, we've had a little bit of a pickup recently, but we're still well below the long-term averages. And I think that's a really interesting point because most people are not talking positively about the UK. Now, you read the news or you read the newspapers, you probably think, well, there's a pretty good reason why. But actually, if you look at the fundamentals, and we'll come on to that a bit more, I'm sure, it's actually very positive there.
I just want to remind all of our viewers that you can share your questions for Ian, and we will take those at the end. I can see a couple coming in already, so please do make sure that you get your questions in to make sure that you have a chance for them to be answered. Ian, I just want to drill into your point about earnings growth a little. I think over meaningful time horizons, it's those companies which grow fastest that really do tend to provide the best share returns or share price returns. So, what do these companies look like, and how do you sort of go about finding them?
Yeah, that's a good question. And look, I think I've got a slide here, and I think it looks at the top 10 holdings of the UK Baillie Gifford UK Growth Trust. And I think we've got the headline there that most people usually assume UK portfolios, and Jen, you probably see there's a lot of, it's filled up with what the usual suspects, shall we put it like that? The big mega cap names that, household names that are, very boring and they'll probably send you to sleep. But look at this top 10 here. It is not the usual suspects. These are very distinctive, very interesting kind of companies. And I could talk about any of them there, but let's talk about, for example, you wanted an example of growth. Well, look at something like Games Workshop, which is the biggest holding in the portfolio. Now, I think this is a really interesting company for a lot of reasons. I think it's one that people in this country are still embarrassed about. People say that they like Games Workshop, or it's a bit of a sad, it's a kind of hobby that sad people kind of do. They should be getting out there. But actually, it is a wonderful business. It's got this amazing global community. It's a very attractive business, but actually, it's growing, and that's a really interesting thing for us. A number of years ago, before we invested in it, one of the things we were worried about is, well, actually, are people going to play this hobby where they kind of buy these kind of models, they paint them, and then they kind of either some people just leave it at that, and other people play games, just whatever you want to do. But actually, and people are worried that you'd have people are using PlayStations and so on. The kids are not going to use these things. This is all very old school. But actually, it's the opposite. This is actually becoming more attractive rather than less attractive. And actually, just as a bit of a sidebar, it's interesting that there's actually been studies done where actually kids who are actually seen as quite hyperactive, when they've been given these kits that have been given out by Games Workshop to schools, and they start painting these pictures, painting the models, quiet descends of the classroom. and people are fascinated about it. And actually, there are a lot of actually good reasons why it's really good for kids' concentration and interest that actually they actually do these types of things. So actually, there's actually it's not this kind of a silly subject. Actually, it's a really good subject for kids because kids actually really find this really interesting. But the thing about Games Workshop is, and why I think in the UK we should be proud of it, is it's got fantastic IP. It's got 30 years of IP that has got stories about all these kind of heroes and space marines and all these types of stories. And they have books and people lap this up. It's very rich. And it was an American company. Everybody wowing about all this amazing in-house kind of IP that they've got that the whole world consumes, but we have it in the UK. It's in Nottingham, and it's this fantastic business. And the reason why that is important is that they've been in talks with Amazon for quite a long period of time about potentially Amazon making a TV program, a TV series about one of their kind of characters, just one of their characters. And you'd have thought, Amazon talking, Big Jeff talking about, to We Games Workshop, you're just going to salute the flag, take the money, and we'll do whatever we want. It didn't happen like that, Jen. The discussions went on for a very long period of time because Games Workshop, the management team, rightly said, we are not going to give this over to you and you can just do whatever you want, because that could kill the kind of the fans' love of what we're trying to do if they make a real mess of it. You have to do it in a way that actually stands true to the characters and the IP, the world that they live in. I think that's incredibly important because it's a company that's thinking long term. That it's got some I should say, I mean, these models, I don't know if you ever bought them, Jen. They are really expensive. They make very good margins on them. So that this is not a charity. This is a very profitable business, but it's got a growth potential here. And we think that something that's not in the price, but it's still to come, could be additional, interest in the Games Workshop world, the Warhammer world, we call it, when Amazon eventually bring that program. So that's a business that is now in the FTSE 100. And I think, that instead of people saying, I remember seeing some TV, some newspaper articles saying, well, this is a bit of an embarrassing thing, Games Workshop in the FTSE 100. It's the opposite. This is the type of business we need in the FTSE 100, a growing business that is globally expanding and is doing really well. Now, a very different business, Jen, is the second biggest one, Volution Group, which I'm pretty sure most people have never heard of. But I'm going to challenge you, Jen. If you're sad like me, I'm sure you're not, but if you're sad like me, when I go into a bathroom now, I look at the fan in the bathroom and I see what brand it is. And if it is Vitaxia, Manrose, or Monsoon, this is Volution. And they're the leader in the UK for these kind of ventilation fans. And surprisingly, this is a very high margin business. This is a business that makes 20% operating margins, turns all its earnings into cash flow. It's a great business. But it's not just fans, you'd probably be glad to hear. It's also these ventilation systems. And those of you who probably bought, or your clients who've bought a new house in the recent years, will know that the ventilation standards have gone up and up and up. Now, the good news about that is, well, the ventilation's a lot better. The bad news is that actually often they were like furnaces in weather like this. And actually what Volution are doing are actually producing ventilation systems, which are now being going into the new houses, which are better to allow the houses to properly ventilate. And that's really important from a health perspective, because you might recall that there was a case a few years ago where a child very, very sadly died because it was inhaling mold spores because the flat hadn't been properly ventilated. So this is a real kind of health issue, and the government have really cracked down on this, and it's really kind of pushing this agenda. So this is a company that, whether you like ESG or green agenda or not, this is a company that's benefiting from that ability of legislation tightening, not just in the UK, but in Europe and Australasia. And again, this is a business that's grown from the UK. It's now, as I say, in Australia, Australasia and Europe. That's about half its sales. So it's a business that's got a great UK base, which is growing because of this legislative tailwind, but it's also got that international expansion too. So that's just a couple of examples, Jen, of businesses people don't normally associate with the UK, but are great British growth stories, and they're still looking very attractive to us on a long-term basis.
Yeah, I mean, it's two very different sounding businesses there, Ian. I have to admit I hadn't heard of Evolution, but I definitely know people who would be big fans of Games Workshop.
Yeah, no, absolutely. But I say, any of these companies, I think, whether it's Auto Trader, it's the number one kind of used car platform in the UK, or Experian, the kind of the kind of the data kind of business, consumer data business. These are businesses that are looking to find and solve problems, or people business like Wise or AJ Bell, they're disruptors that are offering compelling propositions to the customers. And that's what we think is really important, because we're not looking at the top down economic data, we're looking at the bottom up ability for companies to grow. And the one thing I think that, Jen, you don't see in growth a business is the management thing. And that's something that we spend a lot of time thinking about, because businesses that can find new avenues of growth, that is wonderful. And that's what we're trying to do when we're trying to visit companies and get to know them.
Mm. And I want us to I want us to just sort of turn to portfolio activity, Ian.
Yeah.
So I understand that sort of a big feature of your approach is that long-term patient mindset, and that means sort of portfolio turnover will typically be low. I think there was only one purchase in the past year, and that was Applied Nutrition. What kind of piqued your interest there?
Yeah, but it's an interesting one. I should say the reason why we only had one new buy idea was because basically we like the shape of the portfolio, and therefore we're quite patient. We're like, let them let the kind of long-term fundamentals play for you. But in terms of Applied Nutrition, again, it's a relatively small business. It was a flotation, it was an IPO, which is unusual for us. But we were quite intrigued by it for two things. So what Applied Nutrition do is they do sports nutrition kind of products. So if you're into the gym and bodybuilding or running or things like that, you want gels or things like that. These guys actually produce it. But what is interesting is the business itself. It was set up by the current CEO, the founder, Tom Ryder. And what he did was a couple of things. You could see there's a big growth market here. But one thing he did very early on, and it's based in Liverpool, was to make all the products kind of, WADA, kind of the drug agency, compliant, because that's one of the big things for a lot of the really professional sports people, is making sure, and we should be seeing this in tennis and so on, people taking products, and actually there's been some sort of not intentionally, but there's been some kind of contamination within these products, where actually they are very clear in this, that actually these products are absolutely fine to take. There's no problem with that. That's a really, really important thing. But the other thing that really struck us was it was a very profitable business, but it was very nimble. And what I mean by that was that they were very easy to get into new flavors very quickly. So it wasn't a committee; it was moved very quickly. So, for example, I have to say I run. I'm a park runner, and occasionally take kind of gels for that to kind of get me kind of worked up in the morning. They have things like Vimto, kind of flavored gels and things like that, and it's just very kind of innovative, because people like to have new flavors to try and things like that, and they are very much doing that. But what's also interesting is they're coming global. They're not just in the UK, they're in Latin America, they're in the Middle East, and they're in Europe, and they're also in the US. And they've just had, they've had a product at Walmart, for example, and the opportunity there, they can get more products into Walmart is potentially, really huge. So this is a business that likes working with big retailers. It's very small, it's very nimble. The last thing I really liked about it was the board. That the chairman of the board is Andy Bell, who is the founder of AJ Bell, and we have a huge amount of respect for Andy, for what he's done at AJ Bell, and the fact that he's both not only the chair of the business, but also a reasonably sized shareholder in it, gave us a lot of comfort that he thinks there's a lot of potential in this business too. So it wasn't the main reason, but it was certainly one of the kind of nice things to see, that somebody that we a business that we like and respect that founder has actually invested in this business too, and is helping. I think I'm sure helping Tom, go from that, private business to a public business. But again, I think this is a business that we should be supporting in the UK. Innovative, nimble, entrepreneurial, and profitable. I like that.
Fantastic. So, I mean, Ian, clearly you're not completely resting on your laurels personally, if you're going out park running. But does that sort of minimal sort of turnover suggest that the trust might be resting on its laurels a bit? I'm sure that is far from the case, but can you kind of give us some insights into other transactions in the portfolio?
Yeah, no, I mean, look, we what's happening actually, one of the things we've been doing in the trust, the board actually made an announcement last or earlier this year that said that we're going to maintain the discount at a high single digit level, and that's meant we've been buying back a lot of stock. So actually, over the year to April, we bought back about 13% of the trust. And subsequent to that, and this is all public data, you can work it out. We bought another 3% of the trust, since the end of April. So actually, we are, and the discount has come in from mid-teens down to high nines at the moment. So, and that's obviously good for shareholders at the moment because they're obviously that's accretive for existing shareholders, but hopefully for new shareholders, it gives you that comfort that you're not going to buy a share the discount's going to kind of blow out. We're actually buying back that stock. Now, the reason I'm telling you all that, Jen, was that actually one of the things, obviously, you're buying back that level of the business, you're going to have to sell, investments to do that. So one of the things we have been looking at the portfolio is kind of competition for capital. And we have been looking at, which of these holdings, make sense. Are there any holdings in there that we're kind of less enthused by? And we know we have sold one or two holdings, such as, Rio Tinto, where we basically decided that basically the fundamentals was it one of the best 35 or 6 names in the UK we could own. No, it wasn't. We also had something like FD Technologies, which is been taken over. So again, that's another thing that we've been exiting, sort of thing. So there've been a few things like that where we've been looking to not just do a pro rata, if I put it like that, of the whole portfolio. We've actually been targeting holdings which we think which are the ones we want to hold, not sell, which are the ones we'd be prepared to do that. We've also trimmed some things. That's one of the things we've learned in the last few years. If you were asking me what are the mistakes that we made, from say the COVID period, I think we had to keep asking ourselves about, we like that business, but it's done really well. Should we kind of reduce it a little bit? So we've taken some profits in one or two holdings, such as Games Workshop. It's still our biggest holding, but we have taken some money out of it because it has performed extremely well. So that also is other thing that we've been doing there. But I wouldn't put it too much of a context. The portfolio itself, we like it because the fundamentals of it are still really attractive. And I think actually I can really kind of put it by looking at on the next slide here, that I think that kind of really tries to help. If you look at the kind of the gross margins of our portfolio, that they are better than the index. And then equally, if you look at the positive earnings of cash flow, you can see that it's basically a portfolio with strong earnings and cash flow. But I think what is most compelling of all is that I think it's that kind of looking forward. Now, as well as I do, Jen, that all these numbers always have to be taken with a pinch of salt. But it's good to see that even in this tough environment, we're seeing better sales growth than the market in our portfolio, and importantly, earnings growth much better than the portfolio than the market. Now, these numbers are moving around a lot at the moment because of just the markets and so on. But that kind of just telling us what we're seeing at the bottom up level, that our companies are in balance, doing pretty well in this tough environment, and that's really why we're still remaining very positive about things.
Thank you, Ian. And can I just sort of pick up on your comments about buybacks, please? I do think it's probably worth spending a few moments sort of discussing the trust structure. I mean, there are sort of several potential benefits for shareholders. I believe that probably worth explaining.
Yeah, no, I mean it's different from an OIC, for example, in the sense that you have an independent board of directors that are there to kind of represent, the shareholders. We talked about that before, and I think they've been a really, I think they're a really fantastic asset for us, for Milena and myself, because I think they're supportive when they have to be, and also they're challenging when they need to be too. And I think that keeps us on our toes about, the toughest questions always come from the board, and I think that's exactly the right thing to do. But equally, they're wanting to make sure we're doing what we're saying we're supposed to do, which again I think is really important. But I think the structure itself, the investment trust structure, I think is interesting because it allows us to do two things that you can do in an OIC really, which is to gear up to borrow money. So actually we have, we're geared. So we have borrowings which are about 9% gearing at the moment of the fund, not too much, but still gives us a bit more bang for the buck on the upside. But we can also own private investments. Now we have one private investment in the trust, a company called Wave, which you may have kind of come across as a kind of a driverless technology business, which we think is really interesting. And it's got some very impressive backers now, and it's just signed up its first car company from Japan to basically potentially use their technology in a car, which is really exciting. We could talk about that or later if you wish. But these are things that are different that you can invest in an investment trust. But as I said, I think the really important thing is the buyback ability that you can buy shares at a discount. And the board put a line in the sand and said, we're going to protect the discount is going to go beyond 10%, where we will be buying back stock to make sure it stays within that. And the last thing I should say is the board have also made sure that the continuation vote in 27 and 29. And I think what the chairman said was in his annual report, it's almost an each way bet here for shareholders that either things are going to get better or you're going to get your money back pretty quickly, because if we underperform, you have that right to have a vote on that. So I think it's a good analogy, and I don't really need to kind of add it. I think people kind of get that point quite well.
Thank you, Ian. So we are going to move very shortly on to the Q&A portion of this event. I just want to remind you that you can send in your questions for Ian using the chat box. So please do get your questions in. We do have some that have come in already, Ian. You'll be pleased to hear.
Okay.
So I'm going to kick off with one now. So I think you've described your approach as very patient. How do you sort of stick to this? Maybe when things aren't working as well, maybe when performance is a bit more challenging.
Yeah, look, it's a really good question. I mean, I think it's one of the classic ones. You've heard the phrase, Jen, everyone's got a plan until you get punched in the face. And I think it's that type of thing. Everyone says the long term until you have that short term underperformance, and then you're under pressure. But I think what the advantage that we have, Elena and I have, I think, is the fact that first of all, we've got a very supportive investment house. Baillie Gifford is long term. We're not being asked to justify short term performance as long as we are doing what we're saying we're doing now. I can say that it's not easy for clients, I'm sure, for people listening, shouting at you about performance. But actually, I would say is that I'm sure you would say the same thing for a client. Look, there's nothing you can do about it as long as kind of the managers are doing what they're supposed to be doing. You will have these periods when you're out of favor. And I think what's really important for people thinking about this is that the team are being very used to having this style when it's not worked in the past. And what we know absolutely is you don't change that style when you've had that bad period of performance. What you do is you absolutely go through your portfolio. Do you make sure you haven't made any mistakes? And if you have made mistakes, do something about them. But by and large, you stick to your process. Now, that said, and I don't want to sound arrogant there, because it could sound a bit arrogant there. You're always looking to how can you get better? And actually, one of the interesting things, we really challenged ourselves in the last couple of years of what could we have done better. And I mentioned one, which is looking at those valuations don't always just let the things run and run and run, because that was probably one of the mistakes possibly made, in the COVID period. Some of these stocks did extremely well. Performance was very strong. Did we take all our winnings off the table? We could have taken some off. But just to be clear, we couldn't have stopped what was going to happen anyway. It was going to happen to growth anyway, but we could have been more disciplined. We're already starting to do that. But the second thing, which I think is even more important than that, is we've really doubled down on our investment work and our due diligence. And what I mean by that is that virtually all our stocks in the portfolio, we're now spending, um, you know, for each company, often we'll go down for a day a year to meet them in their home territory and to do that. And actually, as I say that, my colleague Milena, she's on a plane and flying over to America to visit 2 or 3 of our companies for exactly that reason, to spend a day with them because, Experian, for example, one of those big businesses in California, Foreign Print, is in a place called Oshawa, which you've never heard of. It's about an hour, a few hours north of Chicago. You can't get there; you have to drive there. But that's where the businesses are really based. You need to kind of go and meet them there in their home layer. But we think it's really useful because you get much more insights rather than just an hour's conversation after the day of results. Spend a day with people, meet not just the chief executive and the finance director, but meet the whole executive committee. That is really interesting. And what's even more interesting than that, Jen, is I'm sure you're probably thinking, oh yeah, but surely you just kind of end up just kind of having a love-in with companies. What's really interesting actually is actually the opposite. It's that we've had a number of cases where spending that day with the companies actually put us off it rather than do it. So it's not that you are always saying, oh, it's all like confirmatory bias. Isn't this wonderful? And it's all a loving. It's not. It's actually quite revealing. A company, what's going on within it. And as I say, there's been a couple of companies where we've ended up selling them after that kind of one day due diligence. But what the final thing I should say there is that this takes a lot of time to put together. But what we've been really heartened by is because we're long term, we're seen as a kind of supportive investor. That we've been able to actually arrange this with companies, and it's something we're really, really pleased with and proud of.
Ian, I've got a question come in from David, I believe. Um, David sort of specifically wants to know whether you think a lot more companies are going to disappear from the FTSE and relocate to the US or other countries. I mean, perhaps you might also want to talk about, whether this sort of worries you and, what might turn the tide here.
Yeah, look, it's a good question, David. I mean, it's the one on everybody's mind to some extent. I mean, I think the one thing I'd say is that churn is what's going to happen. I think it's one of the interesting things. If you look at the data, even look at the FTSE 100 from say 20 years ago and look at it, compare it to today, it's very different. The number of companies that have disappeared, or even 10 years ago, the number of companies that have disappeared is quite striking. So one thing I think people can get a little bit too worked up about is, the fact there's takeovers, things like that. That always happens. Okay, but equally there are new things coming in. For example, like Games Workshop and other things that that's what's happening. The economy does change over time, and you see that and reflecting in terms of companies that are kind of coming into the FTSE and those that are kind of coming out of it. So that's one thing I think it's important. We shouldn't lose sight of that. But I think in terms of the question about companies leaving the UK, obviously, for example, we have Ashted. We've got Wise, which is thinking about that as well. In one sense, I wouldn't say we're very happy about it because the suspicion sometimes is it totally an altruistic reason for why people want to move to America? You might say from a cynical point of view, and perhaps the fact that it's well known that in America you get higher pay for the chief executives and so on. Strike me down if you think that's untrue, but I think there's a kind of an element of that. And the reason I say that is there has been a study which has shown that actually a lot of companies, the argument that the rating kind of discount kind of disappears when you move to America doesn't actually always happen. So I'm not sure, but it's a function, I think, at the moment of the fact that the UK market is undervalued, and I think that's the thing I would leave people. Something's going to happen one way or the other, and I think that's really attractive for the UK because I just think valuations are too low. People are looking at too many negatives and they're not seeing all the positives that are going on there. And I do want to get this point across is that if you go below the top big mega caps, which sound very dull and a lot of time not very interesting, there are lots of really interesting companies in the UK. There are growth businesses in the UK. The UK is not a bad place for business. It's actually a very good place for businesses to invest in. And you also got this great governance structure as well, which I think is really works for shareholders. There are a lot of good things in the UK. We keep encouraging the government and others to say, look, you want to have a thriving, stock market. It's a really important point. We don't want to turn into like a Wimbledon, where basically, our economy is basically driven by people from outside it. It's not healthy for us. I think that there are things that probably need to change there. It's not my job to do that, but certainly I don't think it's healthy. But the good news is there are lots of medium to small companies, businesses that are doing really well, and they've got that great opportunity. And what I want to do is to own them. And I think it'd be a terrible shame if we kind of end up, losing these businesses to other markets.
Absolutely. I just want to remind everybody that you can share your questions for Ian using the chat function. I'm going to jump in with another one now, but if you have a question for Ian, please do share it. So, Ian, I mean, you sort of mentioned that you're kind of going out and sort of seeing these companies. You did sort of mention perhaps that maybe that might almost turn you off rather than sort of make you more likely to stick with them or certainly sort of strike up a relationship there. I mean, how for the ones that you are spending quite a lot of time with and that perhaps you have got to know, how do you sort of retain a level of objectivity there? Is that a challenge, or how do you kind of overcome that?
Yeah, no, it's a good point. I mean, we tried to think about that when we started doing this. We did it, just to be clear, we've always done it, but we've done it really much more in a much more disciplined way in the last 2 years, much more methodical, trying to do it for all the companies in the portfolio. And I think when we're doing that, we almost ask that question ourselves: is how do we make sure that it doesn't work? Well, the first thing we do is we never go out one person. There's always more than one person goes to that meeting. So there's also an objective person there. There's two people in the room, which I think, to be honest, Jen, if I was speaking, if you were speaking to me for 7 hours, you'd probably be pretty knackered at the end of it. Whereas actually having two people doing it takes a bit of pressure off people. But the other thing we do is also we kind of write it up. So for the rest of the team, and we've got a team of 7 in the UK, we come back, we discuss it. And again, the people who are not in the room have their chance to say well, what did they think of that? And that can work in lots of different ways. So, for example, there's a company we were discussing actually yesterday. And the interesting thing for me was that, again, we had that write up of the recent meeting, but I wasn't there this year, but I'd been at the meeting the year before. And I said, look, it's really interesting. The tone on a certain aspect has completely changed. Last year, they were quite blasé about it, whereas now they seem to be much more concerned. Isn't that quite an important kind of shift? And I think that was kind of a really important point, because that wasn't just a kind of one throwaway line. We discussed it a lot with them the year before. They've been quite robust, to the point of almost being a bit blasé about it, whereas now they were almost more acknowledging our concerns, which I thought was kind of quite interesting. And that kind of gets you to the point about what really matters. And that's really our job, trying to sift through the data to try and work out from a growth perspective, what's a really important point? What is this noise? And I think the dirty secret, you know it, Jen, but perhaps not everyone who's listening and knows this. The dirty secret of fund management is that most of our stuff is just noise. Actually, the things that really matter are very rare, and they're the things you're trying to look out for. And trying to distinguish between the two is the job, I suppose. But I think that's a really important point. For long-term investing, a lot of this stuff often doesn't matter. And noise that people remember, people think, 10 years back, they can, oh, I forgot all about that. At the time, it was the big thing, but people have forgotten about it. And that's why we try not at a house not to think too much about the macro and the top down, because a lot of the time it doesn't really matter. It comes out in the wash. So that's kind of things that we're trying to do. But I think it's also just that healthy skepticism, because I think one of the things that we are very acutely aware of, because we are, Melanie and I are both partners in Baillie Gifford, we know that it's our clients that matter, and we are there to represent our clients. And that is the really important point. We're not there to kind of butter up a CEO and, ultimately, I always say it's that you have to have that slither of ice in a relationship with a chief executive. No matter how much you might respect them or like them or admire them, ultimately, if they're not doing the job for my clients, the stock has to go. And I think that's a really important point because I ultimately represent my client. My clients come first. And so for the trust, that's meaning doing the best thing for the trust and for the directors and for the shareholders. It's not about, the executive doesn't like it because I'm going to sell the shares, it's not supportive. I don't care. I am, you can see from our track record, we are a supportive, thoughtful shareholder. But if we think the investment case is weakened and it's not going to get any better, we'll sell it and move on.
Ian, I've got a question come through from Simon. It actually relates to stamp duty. So, how likely do you think it is that the government might remove stamp duty on UK shares?
Well, I'd love it if they did, but I think given the hole in Rachel's budget, I think it would be highly unlikely. But you can live in hope.
Right. Well, Ian, I thank you so much for joining us today. It's been a fantastic presentation. Before we do wrap up, I do want to ask you: is there any particular sort of message that you'd like to leave our viewers with, or any sort of big key takeaway?
Yeah, thanks. I mean, Jenna, again, thanks for the question. If anyone listening to it, I mean, I think the thing I leave is growth investing works in the UK. I had a slide up earlier that showed that it does work. It's not just in the last few years; it's over the last 30 plus years. But you need to be patient. And I think anyone that's got a long-term investment, a horizon, I think should know that the last few years have been really exceptional. They've been a huge headwind for growth investors. I'm not saying it couldn't continue, but I think you've got to say, well, do you really think, interest rates are going to double from here? Do you think inflation is going to treble again from here? Um, I think the more likely opportunity is it's going to at least if it stays the same, it's good news. If it becomes a tailwind, it's even better news for growth investing. But I think the thing I keep saying to people, Jen, is share prices follow fundamentals. And what you've got in the UK Growth Portfolio Trust is a collection of companies that look very different from the market, but what they have in common is that growth potential that we think is going to be there for the next 5 to 10 years, and we think that's really attractive, and we think that will serve really well for shareholders in the future. And they're cheap.
That always helps, right?
Exactly.
Ian McCombie, thank you so much for joining us today. Fantastic presentation. Thank you.
Thanks, Jen.
Now, before we do wrap up, let's take a very quick look at those learning objectives again. Um, by the end of this presentation, Baillie Gifford will hopefully have dispelled the myth that the UK market is incompatible with growth, looking beyond the largest index constituents to demonstrate that growth investing in the UK works. They will also have discussed where hidden gems are lurking, giving insights into some highly innovative companies run by exceptional management teams, and demonstrated why their distinct approach to UK investing can unlock the vast potential on offer. Um, Thank you so much, everybody, for joining us today, for listening to the presentation, and for engaging with the questions as well. It is hugely appreciated. Just a reminder that your CPD will be delivered tomorrow. Um, just before we do close, I'm going to give you a very quick teaser of what's to come from PA over the coming months. Um, we will actually be hosting our next lunch in association with Baillie Gifford on the 6th of August. The topic will be Enduring Growth in a Changing World, and that will be with Monk's Investment Trust investment specialist, John Henry. We have another Baillie Gifford working lunch coming up on the 3rd of September. That one will be with John Stewart, investment manager with their monthly income strategy. And the session will be entitled Decumulation Decisions: Resilient Monthly Income for Retirees. We'll be back on the road again with our autumn multi asset and MPS roadshow. That will kick off in September on the 10th at a brand new venue for us, the Weatherby Racecourse. On the 11th, you'll find us in Warrington. The following week, we'll be in Cardiff on the 16th, in Bristol on the 17th, and rounding off the roadshow with our London visit on the 18th. Delegates will hear presentations from Aberdeen, Aviva Investors, Downing, Quilter, Rathbones, and Standard Life. The following week, we'll be crossing the border for our annual Scotland Investment Roadshow. You'll find us in Edinburgh on the 24th of September and Glasgow on the 25th. We should have an eclectic mix of presentations for you in Scotland, where you'll hear from Cobria Capital, Downing, L&G, Orbis, Schroders, and Tatton Investment Management. All in all, that's a total of 8 hours CPD over the coming months. As ever, if you wish to find more information on or sign up to any of our events, you can do so by visiting professionaladvisor.com/events. That's it for today's session. So all that remains for me to do is thank Ian for his presentation. Thank you so much, Ian. Thank you very much to you, our readers, as well, for your company this lunchtime. I trust you found the session helpful and worthwhile, and hopefully we'll see you next at the next session on August 6th. Thank you very much, everybody.